In 2024, finding high-quality stocks at reasonable prices has become an increasing challenge for investors. Over the past several years, the U.S. stock market, particularly the S&P 500, has consistently reached new all-time highs. This surge is driven largely by dominant U.S. tech giants like Apple, Google, Amazon, and Nvidia. Companies that have grown to such an extent that they now trade at incredibly high price-to-earnings (PE) ratios. For many investors, these stocks are now considered expensive, pricing out those looking for undervalued opportunities. However, a completely different story is unfolding in China. Some of China's largest tech companies like Tencent, Alibaba, JD.com, and Baidu have experienced significant declines in their stock prices over the past few years. These Chinese tech giants, despite being formidable competitors on the global stage, have seen their valuations tumble, leading some of the world's most famous super investors to take notice. For example, the late Charlie Munger, an iconic figure in the world of value investing, saw an opportunity in Alibaba and bought in. Other prominent investors such as Manish Pabrai, Guy Spier, Howard Marks, and Michael Burry have followed suit, investing in a range of Chinese tech stocks. Despite the downturn, these investors remain steadfast in their positions. Burry, known for frequently adjusting his portfolio, has held on to Alibaba and JD.com for over 18 months, reflecting a long-term conviction. So what do these seasoned investors see in these companies? Why are some of the world's largest tech giants trading at such low valuations? And more importantly, what risks should investors be aware of before diving into Chinese stocks? China, the world's second-largest economy, presents a unique investment opportunity. One reason for this is its enormous population, which, combined with the country's distinct political system, has shaped an environment that allows domestic businesses to thrive without much foreign competition. Unlike the U.S., where companies like Apple, Amazon, and Google dominate the tech landscape, China has imposed strict restrictions on large Western companies trying to do business within its borders. Because of these protective measures, Chinese tech giants like Tencent, Alibaba, and JD.com have enjoyed unparalleled growth. For instance, Tencent's messaging platform WeChat saw its user base grow from just 50 million in 2012 to a staggering 1.3 billion in 2023. These companies have established dominance in their markets and built vast ecosystems, making them integral to daily life in China. At the same time, the Chinese economy has been booming. Over the past few decades, the wealth of the average Chinese citizen has increased dramatically. With more disposable income, China's massive population has been spending more on goods and services. This economic backdrop created fertile ground for Chinese tech companies to grow, innovate, and expand at an astonishing pace. And, despite their recent struggles, these companies remain highly profitable. In the last year alone, Tencent generated $26 billion in operating income, while Alibaba brought in $18 billion, JD.com $4.2 billion, and Baidu $3 billion. So, if these companies are thriving from a business perspective, why are their stock prices so low? One major factor that has weighed heavily on Chinese tech stocks is the country's political environment. The Chinese government, through the Chinese Communist Party, CCP, has significant control over its economy and businesses. While this control helped protect Chinese companies from foreign competition and allowed them to flourish, it also introduced certain risks that investors, particularly foreign ones, need to be aware of. One clear example of these risks is the Chinese government's regulatory crackdown on tech companies. In April 2021, Alibaba was hit with a record $2.8 billion fine as a result of an antitrust investigation. The Chinese regulators found that Alibaba had abused its dominant market position, leading to the hefty penalty. Later that year, the company pledged to donate $15.5 billion to the Common Prosperity Fund, a government initiative focused on technological innovation, rural development, and other areas. Many investors saw these moves as government intervention, possibly at the expense of shareholder interests. Similarly, Tencent made large donations in 2021, with one totaling $7.7 billion and another $15 billion. While these donations were said to be voluntary, some investors have speculated that government pressure played a role. These situations illustrate a key concern. In China, the government can and will influence companies. sometimes in ways that could hurt investors. Another major risk revolves around the ownership structures of these Chinese companies. Due to restrictions on foreign ownership, foreign investors cannot directly buy shares in Chinese firms like Alibaba. Instead, investors buy shares in offshore entities known as variable interest entities, VIAs. These entities are set up in places like the Cayman Islands and have agreements with the actual operating companies in China, giving them the right to the company's profits. While this structure is legal, it introduces uncertainty. If the Chinese government were to crack down on VIs, it could jeopardize the interests of foreign investors. Additionally, geopolitical tensions between the U.S. and China have raised concerns that Chinese companies could be delisted from U.S. stock exchanges, further complicating matters for investors. Lastly, China's broader economic conditions pose another risk. The government's tight control over the economy can influence the performance of Chinese businesses. For example, the CCP's crackdown on real estate developers and its reluctance to introduce large-scale stimulus measures following COVID-19 lockdowns have led to a decline in consumer spending. With much of the population's wealth tied up in real estate, falling home prices have impacted Chinese consumers' ability to spend, which in turn has hurt businesses. And when consumer spending falls, so do business profits. Despite these risks, many value investors believe that the current situation in China presents a rare opportunity to buy high-quality businesses at a significant discount. Investors like Manish Pabrai, Guy Spear, and Michael Burry are betting that the risks are outweighed by the potential rewards. In particular, these investors see companies like Alibaba and Tencent as undervalued gems. Take Alibaba, for example. Despite its recent challenges, the company remains a dominant force in the e-commerce space, both in China and globally. From a financial perspective, Alibaba is a powerhouse. It generates around $200 billion in revenue, has $50 billion in cash reserves, and is repurchasing its own shares, an indicator that management believes the stock is undervalued. Currently, Alibaba's enterprise value, EV, is $182 billion, while its EBITDA is $24.2 billion. This gives it an EV to EBITDA ratio of just 7.49, a low multiple that suggests the stock is cheap relative to the company's earnings power. For value investors, the numbers are compelling. Alibaba is generating substantial free cash flow and buying back its own stock, which could lead to long-term gains for shareholders. In fact, with its current cash flow, Alibaba could theoretically buy back the entire value of the company in less than 9 years. This kind of value is hard to come by, especially among large-cap tech companies. Other Chinese companies show similar promise. JD.com, for example, has an enterprise value of $32.85 billion and generated $4.9 billion in free cash flow over the past year. That gives it an EV to free cash flow ratio of just 6.7. Similarly, Baidu, another major player in China's tech sector, has an enterprise value of $23.15 billion and free cash flow of $4 billion, giving it a ratio of 5.8. These low valuations have not gone unnoticed by the companies themselves. Alibaba has repurchased $18 billion worth of its own stock in the last year, while Tencent has spent $1 billion on buybacks. Even JD.com and Baidu have repurchased shares, though to a lesser extent. When companies buy back their shares, it typically signals that management believes the stock is undervalued, a positive sign for investors. The debate over whether or not to invest in Chinese tech stocks has divided investors. On one side, you have prominent value investors who see opportunity in the beaten-down valuations. On the other, you have those who are steering clear due to the political and geopolitical risks. For instance, Warren Buffett, a legendary value investor, has opted not to invest in Chinese tech, despite his longtime partner Charlie Munger's decision to do so. The reason for this divide lies in how investors weigh the risks and rewards. There's little doubt that Chinese tech companies are trading at historically low valuations, but the question is whether those valuations compensate for the risks involved. For some, like Munger and Pabrai, the answer is yes. For others, like Buffett, the risks are too great. Ultimately, the decision to invest in Chinese tech stocks comes down to each investor's tolerance for risk. With the ongoing geopolitical tensions between the U.S. and China, concerns over government intervention, and the uncertainty surrounding VE structures, it's clear that Chinese stocks are not for the faint of heart. But for those willing to navigate these complexities, the potential rewards are substantial. In the end, the current landscape presents both a challenge and an opportunity. Investors must decide if they're willing to bet on the long-term strength of Chinese tech giants like Alibaba and Tencent, despite the many uncertainties that loom on the horizon.